Hey everyone, today we are going to be talking about Revenue Procedure 2428 and the 1099 DA form that will be coming out next year. This is a very important topic, especially with all the IRS notices that are being sent to taxpayers here in 2025. It is very clear that the IRS cares a lot about crypto compliance and they are cracking down on it. And so with this new form 1099 DA, there is going to be a lot of visualization over what is happening in your crypto activity. So it's important that you get compliant soon, preferably not waiting until tax season, but rather do it right now so that next tax season can be very clean. Stick with us. My name is Justin and I am the head CPA here at Count on Sheep. We are a crypto accounting firm focusing on crypto tax preparation. And today we're going to be talking about the 1099 DA and RevProc 2428. So I just want to break it down for you in easy terms so that you all understand what these are and how they impact you. So we'll start with the 1099 DA. This is a new form that will be provided to you by centralized exchanges or custodial brokers like Coinbase, Kraken, Gemini. And this form is a lot like other 1099 forms like 1099B or 1099 interest or miscellaneous. And this form is meant to report the proceeds and capital gains and losses that you incur on those exchanges. So Coinbase in 2026, so for the 2025 tax year, Coinbase and other centralized exchanges will be sending this form to you as well as to the IRS. So both the IRS and you will be receiving this form, and it will be sent to you if you've traded more than $600. So if you haven't traded more than $600, you likely won't be receiving this form, but if you have traded more than $600, you and the IRS will be receiving this form. Now, the important piece to keep in mind here is that this form will not report cost basis in the 2025 tax year. Moving forward, they're going to try to report cost basis, but I'm going to touch on why that's going to be quite a hassle and pretty inaccurate. But the important thing to note for the 2025 tax year is that cost basis is not going to be reported. It is only going to be the proceeds that are reported. So if you were to take this form to a traditional tax preparer or just plug it into TurboTax, they're going to view that as a full capital gain, meaning if you sold, let's say $1,000 worth of Bitcoin and you had purchased it for $900, so you have a $100 capital gain, the 1099 DA form is not going to report the $900 cost basis, and so it's going to look like a $1,000 capital gain. This is very important that you are aware of this because it means that you need to go in and accurately report the cost basis on your 8949 and Schedule D. And that's another important distinction I want to make is that just because you are receiving these forms, these 1099 DAs, doesn't mean that you don't have the responsibility to report on your own on your 8949 and Schedule D. So just like Fidelity and any other brokerage account where you're trading stocks, you get these 1099 forms, you still have to fill out your 8949 and Schedule D for those. The 1099 is just to basically show you what you had traded for the year and then also show the IRS what you had traded for the year too. So for the 2025 tax year, these 1099 DA forms, which stands for digital assets, by the way, is going to report your proceeds, but not your cost basis. So if you don't report your cost basis on your 8949, which you should be doing anyways, then it is very likely that you are going to be significantly overpaying on your taxes, or the IRS will compare what the form to your 8949, and if you aren't reporting it at all, then they're going to suspect tax fraud or tax evasion, which is definitely a path you don't want to go down. So for 2025, definitely make sure you are reporting your cost basis. Starting in 2026, however, these exchanges, these custodial brokers that are required to provide you these forms are going to attempt to report cost basis. Why I say attempt is there's a big caveat. Unlike brokers, traditional brokers like Fidelity, where you're buying and selling stocks, crypto is very versatile. You can transfer it between different wallets and exchanges, whereas a stock for more or less, you buy it on Fidelity, it stays on Fidelity. So crypto, on the other hand, you're able to transfer it rather easily between different exchanges, different wallets, different accounts. And so imagine, for example, you are trading on DeFi, or maybe you're trading on a different account like Kraken, let's say, and then you send those assets into Coinbase, where you then want to sell it or trade it for a different asset. Coinbase doesn't know the cost basis on the assets that were sent into it. They don't know what you purchased it for. They're not talking to your DeFi wallets. And so it's very important that you are aware of this, because a lot of people will just assume Coinbase magically knows the cost basis. They don't. They can't know the cost basis. And so because of this, any assets transferred into an exchange are also not going to have cost basis reported on those. So imagine, for example, you are trading in DeFi, you make a lot of trades, and now you're finally trying to cash out for a fiat, and you transfer it into Coinbase. Let's say it's $50,000, and then you sell it on Coinbase for cash, and at the end of the year, Coinbase then sends you a 1099 DA that says you have $50,000 in capital gains. But maybe that's not true. Maybe you actually started with $75,000 and then you lost 25K, and then now you're cutting your losses and exiting into fiat. So instead of having a $25,000 capital loss, Coinbase is showing a $50,000 capital gain. So this is the dangerous territory a lot of taxpayers will find themselves in if they aren't prepared, which is why I'm trying to warn you about this right now and tell you how to address it so that you don't find yourself in this type of situation. So the first thing that you need to do is make sure that you are using a tax software to look at all of your accounts holistically. This is very important, and it's important that you get started right now, because this is the best way to make sure you have an accurate running total of all of your cost basis moving forward. So when you load everything up into a tax software, you usually have all of your wallets and all your exchanges, and it's important that you have everything on there, not just some accounts. And so that way you can see what's being transferred where and the cost basis attached to those transfers. And that actually leads me into the next piece of guidance, which is Revenue Procedure 2428, which also came out in mid-2024, effective for the 2025 tax year, which is a huge change in how we are going to be tracking our crypto. So Proc 2428 essentially mandates wallet-based cost tracking. And what I mean by this is, previously we were allowed to use a method called universal cost tracking, which essentially means you take all of your assets and you just track them on one giant ledger, a universal pool, if you will. And so if I sold an asset on Coinbase, I could pull a tax lot from Kraken or from one of my DeFi wallets. That's no longer the case after Proc 2428, which was effective for 2025 tax year. And essentially now what this means is every wallet and every exchange, every account that you have needs to be tracked separately, and then the cost basis tracked separately. So if I have an asset on Coinbase and I sell that asset on Coinbase, it has to pull from that tax lot on Coinbase. It can't pull from my other accounts. Similarly, when you transfer one asset to another, or from one account to another, let's say you go from MetaMask and then you send it over to Gemini, that means the cost basis is going to be transferred over with it. And again, this leads me into the importance of having a software tracking all of your trades and your transactions, because it's absolutely vital that you know the cost basis going into those new wallets and new exchanges. So again, if I have 10 ETH and I transfer 5 of those ETH to Gemini from my MetaMask account, I need to know which cost basis on those 5 ETH is going into Gemini, so that when I sell on Gemini and Gemini gives me that 1099 DA that doesn't have the cost basis, I know what number needs to go there so that I can accurately report and make sure that everything is tied together and there is no compliance issue with the IRS. So this video is to essentially be a little bit of a warning for you. I don't want to create a lot of fear or panic, but it is definitely, I'm trying to raise the flag that, hey, this is the time to get compliant. The IRS is serious. We are seeing a significant crackdown on crypto traders. Letters like the 6174, 6174A, 6173, and CP2000 are being sent out in droves to taxpayers right now. We actually made a video on this before. We'll make sure to link that below. But in an unprecedented number, we are seeing these notices from the IRS being sent out to taxpayers. And so this signaling is very clear from the IRS. They've issued the new form 1099-DA, effective 2025 tax year, Proc 2428, effective for the 2025 tax year, and then following it up with a bunch of these notices here in the 2025 tax year. So what that signals from the IRS is listen, crypto community, we're watching and we care, and it's time for you to get compliant. And so as a CPA, I want to make sure that you can avoid any issues with the IRS. We don't want to pay Uncle Sam more than we have to, but it's important that you certainly don't want to pay any penalties. And so if we can avoid those penalties, those simple compliance penalties, we want to do so. So the best thing that you can do right now, get loaded up onto a tax software if you haven't done so already. Make sure every wallet, every exchange, every account that you've ever used is on that software. It's important that you have everything. You can't just have partials. You have to have everything because you need to track the cost basis from one to the other. So once you have everything loaded up, all your data is there, then you need to reconcile your trades. So this is what we call the digital asset reconciliation. You're going to go through, make sure that all transfers are merged together as transfers. It should not show up as a separate deposit and a separate withdrawal. You're going to make sure that there are, all the staking rewards or any other type of airdrop reward is tagged as such instead of just a miscellaneous deposit. You're going to make sure that no random deposits show up in your account. So if we see 5 ETH pop into your account and we don't see a reciprocal withdrawal somewhere, we don't see it tagged as a reward, that 5 ETH is a bit suspicious. We want to make sure we understand where that ETH came from. Typically, people are not just receiving 5 ETH out of nowhere. And so it's important that we figure out where it came from so we can attribute the correct cost basis. And so once you load everything up into the software, once you reconcile all the trades, then you need to make sure that you are compliant with Proc 2428, which means wallet-based cost tracking should be on, and it needs to be consistent with your previous tax filings. And then the last thing that you should do is generate your reports and amend as applicable. So a lot of people, typically the reality is, have not done their crypto taxes correctly. They've more or less just gone with whatever number felt right, and the IRS has made very clear this is not an acceptable approach. You need to report every transaction, and so these softwares will generate the 8949 for you, the Schedule D for you, and then you can go back and either work with TurboTax or a CPA or a tax preparer, and they can help you amend those previous returns as needed in order to make sure that you are compliant. And then once you do those things, once you've amended everything, once you have wallet-based cost tracking on, once all your data is in the software, you can take a breath of fresh air because the hard part is over. Keeping it updated moving forward should be very simple because then you just have to do 1 year at a time. And then come tax season, it's going to be a piece of cake. Trust me, you don't want to be stressing about this come March and April. You want to be thinking about it right now, and then once you do all that hard work, moving forward, it's significantly easier, and then you can rest easy knowing that you are compliant. So those are the things that I want to warn you about. 1099 DA, it's coming out. You're going to get it in 2026, and then Revenue Procedure 2428, that's effective for this tax year, and essentially it requires wallet-based cost tracking. Make sure that you load all your data up into a tax software. Make sure that you reconcile it. Make sure that it's compliant with Revenue Procedure 2428, and then make sure that you download your reports and amend as applicable. And if you would like help with any of those 4 steps or all of them, contact us today using the link below. We are CountonsheepYT, a crypto accounting firm. We specialize in doing this professionally, so we can take care of it for you. Of course, if you want to do this on your own, which we always encourage, you can use Coinly. There's a link below for Coinly. That's one of the softwares that we use here, and it's generally very good, so we recommend getting started there. You can use the link below. Make sure to subscribe.